What we're going to talk about today is market data structure and its impact on how we trade. Now I'm going to try to do this a little more succinctly, so I may go kind of quick here, but it's a lot of information compacted into a relatively small amount of space here. First thing I want to talk about is trading as a stochastic process. Okay, so what does that mean? What it means is this, that trading is not so much about being right or wrong or knowing what's going to happen next in the market. That's not how this works. The way that trading works is very similar. And when I say a stochastic process, what I mean is that it is a statistically based process. Stochastic means random. So it's not about the individual trades that you do. You have to do them right, you have to do them correctly, you have to create edge, apply all the tools. It's about seeing that edge expressed over a body of trades, over a sample size of trades. So the best analogy I can make is a casino. That's business-wise, that's actually the closest business to being a professional trader. Now, when I say casino, what most people think is the gamblers. We're not talking about the gamblers. We're talking about the casino. The gamblers donate the money. The casino is making the money. How does a casino make money? Question I ask all the time in classes. And it's funny the responses I get back, but the way a casino makes money, the way to think about this is that they create a game with a statistical advantage. And they have to structure the way they approach the game in order to see that statistical advantage expressed, to guarantee that it's expressed. The advantage is built into the math. They just have to apply their execution correctly so that they actually see that advantage, that statistical advantage expressed. So they're dealing with the stochastic process. They don't know which hand is going to be a winner or loser, say they're playing blackjack, but they do know that they're going to win about 52% of the hands. So they need to guarantee that enough hands are played, that advantage is expressed, and that they played those hands from their part correctly in order to take advantage of the edge, and a relatively small edge. That is the exact same thing as professional trading. What we're doing is applying a stochastic process so that we don't know what the outcome of any one trade is going to be. But if we create a trading system with a statistical advantage, with edge, we understand that on a significant sample size or a large enough sample size, we will see that edge expressed. Okay, so that's what a stochastic process is. A great book to help you with that a little bit is Trading in the Zone by Mark Douglas. Now, that's a psychology book, but what's really good about that book, and I probably have it in a bookshelf behind me here, what's really good about that book is that he talks about how you think about trading. And it's not the psychology how you feel, it's how you think about applying this process, the stochastic process. And he just tries to get you to think the right way about it. Great book to read on the subject. He doesn't quite approach it from a math standpoint, approach it from a psychology standpoint, but he would get to the same place. I think it's a fantastic resource for that. Okay, next. Okay, so we're going to talk about properties of market price time series. All right, so this is data, market data, and when you look at a chart, we call it's called a price time series, price and time. Market price time series have a few specific characteristics that we're interested in as traders. So I'm going to go through those real quick. This data is nonlinear. This is the most important thing. This is nonlinear data. Nonlinear data has certain characteristics. Now I'm going to show you why this is important later. And we're going to compare linear data to nonlinear data. We'll see what some of the differences are. But nonlinear data. has certain characteristics that these should, sound familiar to you. All right, first one. I'm actually going to go to the second one down on the list that you see here. I'm going to say autoregressive. Now, autoregressive, when you say that, all that means is that there is essentially memory in the data. It means that past events are connected to future events. What happened in the past affects what happens in the future. That should make perfect sense to you as a trader when you think about the markets. We have memory, and we remember what happened before, and we apply that to what happens in the future. Whether or not it helps us or not, it does. The past does influence the future. An autoregressive data set has a lot of other characteristics, but the main thing to think about is that there is this memory going through the data, and this will play into when we talk about trend later. Now, something that's non-autoregressive, that's not an autoregressive situation, would be like a roulette wheel. So go back to the casino analogy. If you have a roulette wheel and you spun it and played one round, that spin has nothing to do with the next spin. The next spin is a completely independent event. So you see people in casinos, they have all the results from all the spins up on a board, and people will write them down, and they'll have them right up there because they know it doesn't matter. There is no connection between what happened in the past and what happens in the future as far as a spin goes. They're independent. In the markets, that's not the case. The data is connected to the past, and the future are influencing. The past influences the future. Okay, now, self-reinforcing feedback loops. Very important. This is going to be our engine behind what creates trends. A self-reinforcing feedback loop, positive or negative, is a loop that influences itself, where, and I'll use a simple analogy here, talking about price. Imagine price is rising. Traders see that price is rising. They anticipate that it will keep rising, so they buy the security. When they buy the security, they're changing the supply-demand dynamic. And that change in supply-demand balance makes the security go higher, which then attracts other buyers who say, well, look, it's going higher and it's still going higher. I want to buy too. And their buying changes the supply-demand dynamic. It creates a self-reinforcing loop. The more it goes up, the more they want to buy. The more they buy, the more it goes up. Now that works positive and negative. There's a lot of reasons why you get self-reinforcing loops. That price analogy is just a very, very simple reason, but they happen all over the place. And as a trader, one of the most powerful things you can do is find and trade with self-reinforcing feedback loops. That's, if you read George Soros's book, The Alchemy of Finance, that's the secret essentially to his him making all the money. He calls it reflexivity. It's self-reinforcing feedback loops. All right. The third or fourth one here is chaotic. The data is chaotic. Now, when I say chaotic, we're talking about chaos theory. And, there's a lot of tests. This is a little more controversial. There's a lot of tests to see how chaotic the data is, mathematical kind of tests that they'll run a data series through to see how chaotic it is. And what they're really looking for is sensitivity to initial conditions. And you think about the butterfly effect, that would be sort of the what they're looking for in the data. I've seen academic papers that say that the data is non-linear, but it's not chaotic. It doesn't pass a lot of the tests that they use to gauge that. I'm going to say that I believe that it is. I'm going to go with Mandelbrot here. He wrote a book called The Misbehavior Markets, and he makes the case that he thinks it is chaotic. I think that it is, but to what degree is not totally sure. But again, that's up for debate. The data is fractal. Okay, so now when data is fractal, the word fractal means self-similar in different scales. Now, this is really important trading. So what it means is that the behavior of the data is the same no matter what scale we look at. So it doesn't matter if I'm looking at a 1 minute chart or a 1 month chart or a 1 day chart. I can apply all the tools that I use. all the indicators I use work the same way. All the trend following tools that I use work the same way essentially. Everything works the same way. It's independent of scale. It's self-similar in different scales. And in market data, when we say different scales, we mean different time frames. Okay, so that's a really important one. Fractal is very important. But we're going to circle back to that. Volatility clustering. This means that volatility happens in clusters. You'll see really big moves up paired up with really big moves down. Volatility tends to cluster together. So what we see is big bursts of energy and then quiet periods in between. One of the things that mutual fund companies always say is, well, if you missed the 10 best days of the year, you missed all the returns. What they don't tell you is if you missed the 10 worst days of the year, you did even better. It's because those big days up and those big days down all happened together, actually. It's two sides of the same coin. So if you missed the best days, you probably missed the worst days too. They don't tell you that. They just want you to stay invested. It's a marketing thing. I understand. Okay, now the last one is really important, which is kurtotic distribution. All right, this is the shape of the distribution of the data. It's not a normal bell curve. That's the key thing. So when the casino deals with their games and the math that they're using linear math and they're dealing with regular bell curves, which is much more predictable. What we're dealing with as traders is a kurtotic distribution. And this is really important because it changes everything. A nonlinear data set, it's autoregressive, is going to have a kurtotic or fat tail distribution, meaning that outlier events are going to happen a lot more often than you would expect. And we're going to get into that, into some of the math on that. Typically, from some of the work I've done, shorter time frames tend to be more kurtotic than longer term time frames, meaning things kind of normalize or smooth out on longer term data. But all the data is kurtotic. Large outliers occur much more often than would be expected, and that is key to building or creating a lot of characteristics that we take advantage of as traders. So that's going to be an important thing to look at. Okay. All right, so some nonlinear behaviors here, trend irregularities. All that means is you get trending behavior, but it doesn't just smoothly trend. It does all kinds of crazy stuff. It'll trend with all kinds of breaks and weird zigs and zags and everything else. It's not smooth, is really what they're getting at. And for anybody who trades, that sounds real familiar. Volatility clustering we talked about. Market data is what we call non-stationary. It means that it moves. It doesn't stay in the same place. Stationary means it stays in the same place. So there are indicators and data points that I use that are stationary data sets. Percentage of stocks over 50-day moving average. That would be a stationary data set. It can only go from 0 to 100. So it doesn't go anywhere. Non-stationary data, like a regular stock chart, will move through time. So it's non-stationary. Now, non-stationary data does have periods of stationality in it, and we'll talk about that because that's where mean reversion trading comes in. Long-term dependencies, this is that autoregressive thing. It's like where past events affect future events. And I always tell a story when I was a new broker in the business. When I just started in the business was 1990, I want to say. The crash of 87 had just happened a few years before. I couldn't call anybody on the phone. I couldn't talk to anybody who was involved in the markets that didn't just obsess over 1987. And you guys know what happened in 87. The market dropped 20% in one day. So it was just, that's all anybody ever thought. Every time the market ticked down, you got 2 ticks down, it was 87 again. And it had definitely affected people. They would pull money out. They were terrified. So any kind of downturn was a crash again. What happens in the past affects what happens in the future. All right, chaotic behavior we talked about, non-Gaussian distribution we talked about, fractals we talked about. Okay, now the last one is probably the last point here is one I would talk about: exponential growth functions. So an exponential growth function comes tied in with the self-reinforcing feedback loops, and this is when something can really accelerate, and you get what's called a J-curve function, where it just like a power function, where it will just really move out. That's a characteristic of these nonlinear systems, and it's something that we're on the lookout for. A good example of that would be something like a self-reinforcing feedback loop with a growth function attached to it would have been a stock like GameStop. Perfect example. Because of the short position, the technical position of what the stock was doing in the background, it created a short squeeze that was a self-reinforcing loop. The more it went up, the more the guys had to cover their short positions, the more buying because they're covering the shorts, and they squeezed it with a self-reinforcing feedback loop, and the stock made the stock go up in an exponential fashion. Perfect example. Okay, now here's the fat tail distribution that we talked about before. Now, the key part of the distribution is this. Is this fat tail area right here. The fat tails it's the whole thing. Otherwise, it's just bell curve. So the fat tails tell us that in this sort of distribution, rare events aren't really that rare. They happen a lot more, and they have a profound impact on what we do. Now, there's two things here. The fat tails will tie into the data itself, and they will also tie into, hold on just one sec, guys. They will also tie into, I'm sorry, I'm trading here, so I'm just trying to do this in the middle of a trading day. Your returns. So the results of your trades. So your trades, the end result of your trades will actually distribute in the same kurtotic fashion. This distribution plays out through everything we do in trading. The data itself and the results of our trades will distribute kurtotically. Well, what is the impact of that? What does that mean? All right, so first off, let me just show you what a kurtotic distribution looks like in the actual data. So this is a logarithmic chart of the Dow. And what you see underneath is the daily percent changes in returns. So it's normalized, log normalized. That way, through time, it's relative, and it's all on the same scale, essentially. All right, you'll notice that it's not very orderly. There's a lot of spikes here, big jumps, and those jumps are greater than 2 standard deviation moves. Now, to give you an example, that's the fat tails. The greater than 2 standard deviation moves, that's all the data that's falling into the fat tails. And we can see from this graph here that there's quite a bit of it. By the way, I took this chart from Mandelbrot's book, Misbehavior Markets. Very good. You should read it. All right, so now if you look at this, the really big spikes, so you see this really big spike down right here, that's the crash of 87. That's a 20 standard deviation move. It's massive. Now, if the data was normally distributed in a regular bell curve, a move like that would be next to impossible. It should never happen. The likelihood of it happening would be 10 to the 50th power days. So 10 followed by 50 zeros, that many days that event should happen. I don't know how many years that is. I haven't done the math, but it's a lot. It's like 100 million years or something. Okay, so the crashes and big events like that, they happen a lot more than would be predicted by a normal distribution. This is a direct, if you ever read like A Random Walk Down Wall Street, and a lot of the assumptions going back to even Eugene Fama, they were just assuming the market was distributed normally in a bell curve. They had to modify all that as they went along, but it's not true. It's not how it's not a normal distribution. It's a Kurtotic distribution, and it changes a lot because of that. It changes a lot of things. All right, so this is what natural, this slide here shows you what natural data looks like in the real world. The next one, this is artificial data. This is what, if it was normally distributed, this is what the data would look like. If you look on the bottom, you see how range bound it is, where it's nice and neat, and there's no real, there's no spikes in there. There's no big moves, right, above 2 standard deviations. So we can, if you use that artificial data and put it through a random walk, you can create something that looks like a chart. You look at the data. And I actually participated in a, this is going ways back, they did an academic study, and they were trying to figure out, they went to the CMT association, at the time it was MTA, and they were trying to, the theory was you couldn't tell the difference between artificial and real data. So if they created artificial data like this, that as a market participant you wouldn't be able to tell. And they were surprised, because what happened is they distributed this survey. It was like an online test that we took to MTA members, and it turns out you can tell, is what they found out, because it got back, and predominantly, I mean, almost everybody could tell the fake data from the real data, so that there is a difference. Okay. Another way of looking at the same thing, here, the top chart here is real data from the Dow, and you see the big spikes there, and the bottom is artificial data. And you notice how nothing really gets above 2 standard deviations on the bottom, but on the top we get these large spikes. Those spikes are the key to making money, turns out. Okay, why? Okay, so first thing is, with this information, and now I'm going to kind of shift gears from the data to your actual trade outcomes. They distribute in the same way. So if I do 1,000 trades, I'm going to get the same sort of distribution. If I do 1,000 trades, I just throw them out there in the world. I check back in a year, and I see how they did. I'm going to end up with a distribution that looks like what we're seeing here. And I'm going to have some trades, about 7%, that were really big winners. I'm going to have the same side of really big losers, about 7%, 7 to 10%. Everything else is going to fall into the middle and just be part of the drift. That's the whole middle part of this distribution that you're looking at. Now, I need to structure what I do knowing that that's what's going to happen. Knowing that if I throw out these 1,000 trades, this is how they will distribute. I then need to look at this and say, how can I make this work for me? Because this is what it is. I don't know which of those, if I do 1,000 trades, I think they're all winners. I don't know which 7% are going to be the real winners. And I don't know which 7% are going to be the real losers. So, you may not have known that if you bought Bitcoin at $200, it was going to go to 60,000. You may not have known if you bought XYZ stock, Reversion or one of these EV stocks that collapsed, that it was going to go to zero. You didn't know. You thought it was a good stock. You thought it was a good trade at the time that you did it. But the distribution is going to fall pretty reliably in this kurtotic fashion. So how do I structure what I do to take advantage of it? First thing you got to do, risk management. Right? Now, the purpose of risk management, if I ask traders, say, why do you use stop loss or why do you use risk management? What they'll tell you is, well, so I don't lose money. Yes, that's true. The real reason you do it is to cut off the left side of this distribution, and the key thing is to get rid of the large outlier losing trades, the disasters that are out there, and they're in there. If you do 1,000 trades, there's about 70 disasters in there, 70 to 100 bad, really bad trades. I don't care how small you are. So the purpose of risk management is to cut off the left side of the distribution so it doesn't even exist. And everything that would have fallen out in that area all clumps up against that, where that stop loss line or where your risk management would be. Everything kind of just, all the bad trades pile up right there. So you're going to have more losers typically, depending on your strategy. If you're trend following strategy, you're going to have more losers than you are winners because that whole side of the distribution is bumped up against wherever your risk management is. But that's okay. Doesn't matter. You're still going to make money. The other opposite of that is we can't get out of the trades too early. Targeting. Big problem with experienced traders is targeting. You have to be there. Look, it doesn't do you any good to buy Bitcoin at $200 and it goes to 60,000, but you sold it at 220. Right? You have to be in the trade when the trade works out in a bigger way. So correct targeting so that if an outlier does develop, you're in the trade. Now we'll get into all this tactics kind of stuff in another video. Strategy and tactics. This is more strategy, big picture. The third thing is sizing. So risk management, targeting, and now sizing. Sizing is how much risk you take per trade. How much are you going to lose on a trade if you're wrong? That's very important. Now, there's some math that's going to be involved with that. I'm going to have a separate video on that too. Sizing is critical. But the key thing for sizing is that you survive, that's the goal, long enough to see all this play out, to see this distribution develop. It doesn't help you if you blow out on 3 trades and you're done, you lost all your money. It's not a business, right? It's not going to work for you. The casinos will not allow day position size. They need to survive in the game long enough to see all the math play out and see the odds play out to their advantage, to be advantaged. That is exactly what you do as a trader. All right, so risk management, targeting, sizing. Next video, I'm going to get into that in depth. All right, now, edge is the next important piece. These, when I talk risk management, targeting, sizing, that's trade structure. That's the baseline starting point for every trade that you do. You have to have that in place, otherwise you won't be able to realize or see the edge. Now, in trading, there's only 2 ways to create edge. There's thousands of variations on these 2 themes, but there's only 2 real base themes. And those 2 themes are mean reversion and trend following or momentum trading. All right, so let's get mean reversion first. Mean reversion is really taking advantage. If you look at this graph right here, it's taking advantage of this middle part of the distribution. Okay, now the data is mean reverting, right? You notice how you can have big spikes, but they always come back, right, to the baseline. Like you always get back to the middle. Now, the key here with mean reversion strategies to survive is you're not trying to, the spikes are what you want to avoid, essentially, mean reversion, but it's all the stuff in between. About, I'm going to say, 85% of the data, 86% of the data is going to be, just noise. And that noise is where the mean reversion tactics work. You haven't got any impulsive action. Those spikes aren't present. So it's the kind of day-to-day stuff. Now, all the noise that's in between the impulses, essentially, is favorable to mean reversion trading. Now, a lot of quant funds, really concentrate on mean reversion trading and all the variations of it, pairs trading, statistical arbitrage trading, everything that's really mean reversion, it's tied to mean reversion. That's because mathematically it's a lot easier to model this. And you can create in a mean reversion system a high win-loss ratio. The only problem is you can have the high win-loss ratio, but because it's mean reversion, you're taking advantage of just the vibration between, say, two standard deviations. You're taking advantage of the vibration between there, but there's really no blowout moves. You're out of it before it goes anywhere. This means that the yield on this type of trading is low. You can be right a lot, but it doesn't make a lot of money. Now, the way that the quant funds make up for that is they try to spin it up. They try to change fractal dimensions. They try to spread out horizontally. They incorporate computers to do, just the idea is to do a lot more trades. They're low yielding, but we'll try to do more of it. Or they may size up, which is more dangerous, and that goes back to the sizing problems. So mean reversion is from a quant perspective, one of the most common strategies that's incorporated, and it's really taking advantage of the middle of the distribution. Okay, so if we look at this data, we can see where the volatility is clustering here, and just think of it this way for where mean reversion works. Again, only 14% of the data to 20% of the data is going to be that spiky nature. The rest of it's the mean reverting noise that happens in between there. And that's what's called a noise state. The market is more often obviously in a noise state than it is in an impulsive state or a trending state, or it's in feedback loops and that kind of stuff. So again, you can be right a lot, you just won't make a lot of money with it. The next characteristic is, or the next edge tool that we're going to look at, our edge creation tool, is trend. And this is what I do primarily, right? And there's a reason. Most discretionary traders are, and most of the people you've heard about that are wealthy discretionary traders, the George Soroses of the world, and Steve Cohen's and the David Teppers, they're primarily trend traders, okay? And the reason is they're not computerized, right? So they're not, I'm sure they are, but you know what I'm saying. They're not fully math-based strategies. They're doing less trades. And what they're trying to do, though, is they're trying to capture those exponential moves, those feedback loops, and they're trying to find something that's going to really, go. And they're going to be wrong a lot more. That's one of the characteristics here. But they're going to make a lot more money when they are right. So it's okay to be wrong as long as when you're right, you make a lot of money. And trend following or momentum trading is where you can do that. Now, the key driver here for trend is the fat tails in the kurtotic distribution. That's the key here. So the fat tails equate to the spikes. So if you look on this graph right here, you see the two fat tails, and then you see the spikes in the data. That's where that data resides in the distribution. Okay, now, what makes this work is combining the spikes, the outlier data, with feedback loops. And again, I explained earlier, feedback loops can happen for lots of reasons. I'm just using a really fairly tame or simple idea of, hey, you see the price go up, that gets you excited, you buy it, you change the supply imbalance, and it goes up more, which brings in more buyers, and it feeds on itself. You probably experienced that a little bit where price is self-justifying. Like, why is that stock going up? It's going up because it's going up, and why ask questions? Just buy it. And people, will chase a stock. FOMO. All right, so that's an example of a feedback loop. Again, it can happen for fundamental reasons. It can be driving business in the real world in different ways. There's lots of reasons. I don't want to get too deep into that, but they are incredibly important. So self-reinforcing feedback loops are something you should always be on the lookout for. Now, what a self-reinforcing feedback loop and how that feeds back into with the outlier data spikes is that when something starts to happen that's changing the supply-demand dynamic, what we start to see in the data is that we'll start getting more of the spikes on one side of the equation versus the other. We'll get more spikes. They're random when they pop up, but we'll get more spikes, say, on the upside in a positive feedback loop. And that's what creates the trending price action. So as that feedback loop kicks in, we periodically get this impulse that pops up, moves the price action forward. And it could happen very quickly on very few data points. But then the data just reverts back to the noise state. Now, the thing is, it popped up on the impulse and then reset the level where the noise state was going to take hold. So now the noise state, it's moving back and forth, stay within 2 standard deviations back and forth, in just a noisy kind of way, and then you get the next pop, because you're in that positive feedback loop, let's say it's positive. You get the next pop to the upside. So you get one bar that takes you up, you're back to the noise state. You get another jump, and then you're back to the noise state. So say you had 20 bars, maybe only 2 or 3 of them, and I'll say 2, created all the actual motion. The other 18 were just noise going back and forth and really not going anywhere. What's interesting to me is that once you get that spike, that data point that pushes everything up, it will hold generally at that higher level, and then the next spike will take it to another higher level again. So, displaying that supply-demand imbalance. And if we look at this graph right here, that's exactly what we see. This is tools that I created, and if you look right here, the red in the middle, that's all the spikes. That's the noise and the spikes together. That's the data. That's log normal, bar by bar returns. Now this is a 60-minute chart that I used. So this is the percent change every hour, and you can see there's some spikes here, right? So what I did, and the red line on the bottom will show this, I measured all the spikes that are above 2 standard deviations on each side and created a net differential, and that's what this red line is. So when this red line is rising, like you see right here at the end, what it means is that there's more spikes happening on the upside than to the downside. And tie that to what you see in the actual price action. You see how it's trending higher during this time frame. So as more spikes popped on the upside, more outlier data points within the price data, it created this net differential, and it's pushing the data higher. That's a self-reinforcing loop, and this is a great example. This is the recent run-up that we had in the QQQs. We've got a lot of money flowing in there, and a lot of FOMO, fear of missing out. And people are excited about the price action, so they're just buying it, and we see the manifestation of that in the data. And we can see previous to that, when it was going down, it's going down because there was more spikes on the downside, and we can see that with this net differential falling. Okay. Next thing. The data is fractal. Every part of this data is fractal. So no matter what you use, indicators, anything, it's all fractal. Self-similar, fractal means self-similar in different time frames. So we call that fractal dimensions, whatever fractal dimension we're in. Self-similar in different scales, what I should have said. In the markets and market data, we do scale by time. So no matter what time frame we use, the data will show structure, it will, indicators will work the same way, everything's the same. If I took a 10-minute chart and took all the labels off it and told you it was a daily chart, and you never saw the day before, theoretically you wouldn't know the difference. In trend, when a trend develops, one of the things I'm going to look for here is one of the building blocks for a trend is this base fractal for trend. And what a base fractal will incorporate is an impulsive move with a noise state followed by another impulsive move. So it's impulse, noise, impulse, surge, noise, surge. That's that, say there were 20 bars in this fractal right here. 2 of them created motion probably. The rest of it is all noise in the middle between those 2. Now, if we have a self-reinforcing feedback loop, what will happen is those fractals get combined together. So, and we start forming the structure. So anytime you see somebody draw a trend, you'll see they'll draw like a zigzag line. It'll be impulse, correction, impulse, correction, impulse, correction. Well, it's because of the way the data is playing out with the spikes, right? Where we get surge, right? An outsized data point, say to the upside, noise, upside move, noise, impulsive move. Take those 2 base fractals, click them together, and you end up with impulse, correction, impulse, correction, impulse. So it's zigzag. Now, to the left here is the theoretical on what I'm talking about. To the right is actual real market data. And again, this is a chunk of data from the Qs, I think. And you see here an impulse, correction, impulse, correction, impulse, correction, impulse. You know, it's not going to be super neat like we saw there, typically. Sometimes it is. But it's the same idea. You can see it right here in the data. You have no problem finding that. As a trader, we're looking for that circumstance. That circumstance doesn't always exist. We're actually going to go through, find this circumstance happening, and take advantage of it, create edge. So the idea is not to know what's going to happen next. The idea is to find situations that are advantaged, like I see a trend developing, and to join the trend. Okay, now a trend is also fractal, right? So these time frames, this is another thing you got to worry about, these time frames affect each other. Let's say I'm looking at a chart right here, and that's a daily time frame, right? And I see a nice, impulse, correction, impulse, correction, impulse. I see a good chart structure or trend structure in place. I could take a piece of that, like that last impulse move there, and I can break that down. If I zoom in, say look at a 60-minute chart now, I can see impulse, correction inside of that impulse move. So this is, again, the manifestation of that fractal nature of the data. And you need to worry about that, because just because you're looking at a 60-minute time frame, let's say, doesn't mean what's happening in the daily time frame doesn't matter anymore, right? They live in the same universe, so they will interact with each other in certain ways, and you need to, that's where the multi-time frame trading comes in, to deal with that fractal nature of the data. You know what's happening in larger time frames if you're trading in smaller time frames. Okay, so the conclusion here, to wrap all this up here, is you need to understand the nature of the data that you're dealing with. You need to understand what it is. And if you're going to do this, if you're going to learn more, you've got to really kind of look into the nonlinear nature of this data and work it out. This is a good start. Hopefully it's a trailhead. It starts introducing you to some of these ideas and moving forward. By the way, the idea that I just put forward about the spikes in the data, kurtotic data affecting creating trend, I think that's an original idea. I haven't seen anybody else talk about it like that. If you've ever heard of somebody talk about it like that, let me know so I can go look up this stuff. But I haven't been able to find anybody else making that connection between the kurtotic nature of the data, the spikes and tail, and how it actually manifests into the trend. So this is, well, let me know. If you've heard anybody else ever talk about it, let me know. I'd love to know. Second point, trading is a stochastic process, right? This is a statistical process. It's applied statistics. You need to approach it from that perspective. It's not about you being some kind of guru genius and you know what's going to happen. No. It's about approaching this the right way so that you can advantage yourself. And you don't get I catch a lot of criticism from time to time for talking about trading in the terms of physics. And I don't mean it like it's metaphysical and it's physics. What I really mean is there's math involved, and you gotta obey kind of the rules of the road because you don't really have a choice. I don't care who you are, you do enough trades, you're gonna land on a lot of clunkers. And you need to be able to get rid of those real quick before they become a problem. But you don't care, how smart you think you are, you're still gonna find bad trades. You just are. And if you find great trades, you need to be there when it happens. So this idea of the kurtotic distribution applying to your trade results is really important. All right, so again, understand that this is applied statistics, and you need to approach it from that standpoint. If you don't, you're going to have problems. It's not about your trade, it's about your process. Does your process work? Not, did you catch a good trade? Okay, and then that's trade structure. And the last piece, edge creation. All right, so mean reversion and momentum systems are really the only two choices that you have. There's lots of variations. There's tons of them. I guarantee any variation in anything you're looking at is either a mean reversion strategy or a trend following strategy, and that's just the way the data plays out. That's just a response to what the data is. Okay, so let me stop right there. I'm gonna follow up with more videos on how to create trade structure, create edge, tie all that together, and many other subjects that I gotta do. So I'm just gonna bang these out kind of one at a time and see where it takes us. This was a really important subject to talk about before I talked about the other things. So I already talked about prospect theory. If you're having problems trading, being profitable, go watch that video, because that's probably your problem. 99% of the time, that's the number one problem that traders have, especially if you're a new trader. All right, so we covered this subject and market data structure, and then we will cover trade structure in the next video. All right, thank you.